Welcome back, everybody. Derrick Soo, your East Oakland advocate. Well, today we're going to do something a little different because I've had quite a few friends been calling me about how to safely invest their money. So we're going to do something a little different. I'm not a financial expert. I'm not a financial um, licensed financial person, but what I bring to the table and what qualifies me to talk on this subject is experience. I've lost money, I've made money, and I've lost money again, and I've made money back. So, with that, as a lot of you know, uh, when I was out on the street, I worked or I operated as a confidential informant for many law enforcement agencies. And through one of those CIs, confidential informant tasks, uh, I was I helped bring down Oakland's largest Oakland's largest ever cannabis grow house or grow operations. And it didn't span just one operation, it spanned 14. 14 locations here in the East Bay. And I got a portion of that money that was recovered from the shutdown of those operations, the cash that was confiscated in those operations. And so uh, a lot of people were, well, what did you do with all that money? Well, first thing I didn't do, I didn't go out and spend anything. So just like if you were the winner of the California lottery or any lottery, and the lotteries require you to have a financial expert to help you not do stupid stuff with your money. In the beginning, when I was young, I didn't have any money, and I was struggling with investments, stocks, bonds, mutual funds, all of that, like a lot of you. And it's a big worry these days because the market is so volatile. Back in the 80s, I made bad investments, and that ended up making me go bankrupt, along with that marriage that was associated with that. All of that was put behind me. I rebuilt my life, and but I struggled financially. I did everything that a lot of you are doing: stocks, bonds, mutual funds, 401ks, and yet the market is fluctuating. It's very volatile these days, and we're seeing a lot of layoffs. And I had a lot of people that I know in the financial market who gave me advice along the way. Some not so good, and some incredibly good. In fact, one of them saved my butt in the 90s, just before a big stock market drop. I got out of the stock market. In fact, I bailed out of the stock market. I never returned in 1996. I got out of the stock market, never went back. And then I made money once I got out of the stock market. And the thing was, when the stock market was great, I was making pretty good money. I was seeing returns of about 7-8% on my stocks, bonds, mutual funds, which is pretty typical, and that's not bad. But these days, we're not even seeing that. I have friends who are seeing 1.9, maybe 3% at best when they have a really good stock. So one of the things that also comes to mind, because after I lost my money, one of the things that the government had with all of us who lost significant money because of the subprime loan culture that existed back then. And that's how I lost $3.25 million of my wealth. And it covered all three of my financial institutions. Washington Mutual, they were the second largest bankruptcy in American history, and that they held a majority of my money. Then we had Citibank, who was also complacent, and then Smith Barney, who no longer operates. And they were my they oversaw my portfolio, and all three were in cahoots with the subprime loans and the misinformation about how it was handled. But anyway, through that bankruptcy, United States bankruptcy courts saving a lot of the banks, but screwing us investors. I had a 20-year contract with the Treasury Department if in the event I was able to recover all of my losses, $3.25 million, but that's just the taxes. So I actually covered up to $20 million of income that will be non-taxable because of my exemption with the Internal Revenue Service and the Treasury Department because of that huge subprime loan fiasco bankruptcy that destroyed a lot of America and really threw into question real estate. So since I recovered all of my money, I'm no longer bound by that confidential agreement with the United States government, the Treasury, and the IRS. So I haven't. I had 20 years. So that was 2007. I had up until the end of 2027 to recover up to $20 million of income that will be non-taxable. And so I didn't recover that much, not as of yet, but I have a substantial amount. We'll just use a nice, easy number, which is a pretty standard number for the lotto also. So this applies if you had won the lotto today. If you had $7 million in your pocket, what would you do? First thing that a lot of people do, they go out and buy a whole bunch of stupid stuff, cars, homes, and things. Here's what you really need to do. If you have a financial planner, a good financial planner will tell you, number one, how long do you plan on living? And you say, well, I plan on living forever. Well, not realistic. But anyway, you want to make plans for a realistic lifetime. Typically, you want to range about 80, 85, which is a good number to work with. And so that gives you plenty of options, time frame, timelines to work with. And in this case, because the stock market, mutual fund market, bond market, all of that is so volatile these days, and we're seeing a lot of layoffs in tech. So that's signaling a future drop in stocks, bonds, and mutual funds. That's the red flag that you need to look at. And I know this from experience because it's happened to me every time when I lost my ass in the stock market, the bond market, the mutual funds, and 401s. It was because there was a big drastic drop in the market, the bond stocks market especially. And then real estate is very volatile right now because it's overpriced. And so you don't want to invest in real estate right now to put your money in and hope that it goes up, because that's a really stupid bet right now with everything so overpriced. But one of the things that we have had that's really safe, there's no risk whatsoever. No risk. They're called certificates of deposit, CDs, and specifically 1-year CDs, because they have the highest interest rates right now. And if you look around, you can even tap and hit 6% return, annual return, 6.12% annual return on a CD, a 1-year CD, not a 2-year. 2-year CDs, you're just over 5% annual percentage rate of interest that you're going to gain. And so we'll also use a nice number, because CDs, number one, you need to have typically about $50,000 to invest and to put aside. And the reason why I say this is also safe, those CDs are also protected FDIC. So you're not going to lose anything if the bank goes belly up. You're going to get your 250,000 back. You're not going to get your interest, but at least you get your 250,000 back. So what you want to do, you want to go up to that maximum $250,000, and you want to do this every month, if at all possible. If you have that kind of money, which is an example I'm using because that's the example that I have modeled. I have $250,000 in a 1-year CD gaining 5.85% interest, annual percentage rate. So with that, what that means on a 1-year CD, $250,000 deposit, that translates 1 year later to an income that you have options. You can either reinvest the money or you can take it out. In this case, I'm taking it out because that's going to be for the business, and that money, that interest does not affect your principal that is working for you. You keep rolling the CD over, but you take the interest out on them, and you do this like I've done, set it up so that you have one rolling over every month, and it continues. It just continues and continues. And so I have 28 accounts across 4 different banks, and I have a money manager to watch over it. And while that sounds like a lot of money, $250,000 to invest, that's the maximum that you're going to be insured FDIC. 1 year of interest brings you in $14,625 at 5.85% interest, and it'll be a little bit more if you manage to hit 6%. And across all the accounts on an annual basis, once the first cycle has completed, which I've already done, my business has in its account little over $409,500. That's a good income for just interest only. That's what my business, and that's what I'm going to be leaving behind, the legacy that I leave behind for the foundation that I've put in place. And that's a constant income. And we never touch the principal. I can add to the principal, adding more CDs temporarily, but that's the money manager's job, to see where the safest investments are with little to no risk and the highest possible interest rate. Right now, because of the higher interest rates on housing, that's what's bringing your certificates of deposit up. You don't want to do T-bills because Treasury bills right now on a 1 year is only 5%, a little over 5%, 5.05%. And so what that translates in an annual income on a T-bill is only $12,625. So approximately $2,000 less, because you got a T-bill with 0.80% less interest. And so that's why I say certificates of deposit. But look around, make sure you're getting the highest possible interest rate, the APR, but only do 1 year. Don't do 2 years, and definitely don't do a 5-year. When I was young, I did 2 and 5 years, and then my financial advisor opened my eyes and said, "Why did you do that? That was a dumb move, because You don't know what's going to happen 2 years, 5 years from now, 1 year. And that's where I stuck to. And so right now, if you did a T-bill, that would mean an annual income of $353,500. And that would be taxable income. But because of my tax exemption status with the Treasury and the IRS, I don't pay any taxes. And so that's free and clear money for the business. And the business will operate, will continue to accumulate that money on a monthly basis income of about $14,625 until further notice, until the rollovers end, because as each one ends, a new rate can appear. But right now, the rates seem to be holding steady at 5.85%. And like I said, there are some where you make a slightly higher deposit. It can go over 6%, 6.12% is the highest that I've been able to find. But also, since it's no risk, that's pretty good. But again, if you want to go above the FDIC threshold, then that's up to you. I myself, no. I'm going to stick with what is FDIC covered at all times to have zero risk. I have zero risk on this right now. Whereas on stocks, bonds, mutual funds, and even your 401k, you have risk, you have volatility. With a CD doing 1 year, you take out the interest, you leave the principal alone. You gain, you come out way ahead. And that's how I'm able to also live on my basic Social Security. So hopefully that helps some of you who may have some concerns about the volatility in stocks, bonds, mutual funds. Again, like I said, I am not a licensed financial professional, but I work and I hire and I have on my staff a professional financial person. And so I take this advice from all of my advisors, and I'm passing that along to you. And hopefully that will help you become more financially stable as you move into the future. Thanks for joining me today. We'll be right back.